Welcome to the Retirement Game Plan Podcast with Greg Johnson. Welcome back to the Retirement Game Plan. In our most recent episode, we talked about the process of retiring or how we go about retiring. Today, we're going to jump into some more specific items, and that's one really important truth when it comes to retirement, and that's that you don't retire on assets, you retire on income. So the real question becomes, where does that paycheck come from? Because in retirement, you no longer have the employer paycheck every couple weeks that shows up in your bank account. You've got to create that income out of the assets or the resources that you have. And you're the one responsible for creating that income. I want to cover three different topics in today's show. The first one is income layering. What are the different sources or places that you could potentially get those sources of income from? The next one is withdrawal order. You may have different types of accounts. Where do we pull from first? And the third one, and a really important one for retirees, is sequence of returns and the impact that that can make on your retirement plan. So hopefully if you enjoy or find value in the topics that I share today, you'll take this show and you'll pass it on to somebody that is getting prepared to go into that retirement stage of life. And hopefully we can help them become better prepared for the journey that they're about to go on. So let's dive into income layering. So let's face it, in retirement, most people are going to have multiple sources of income that are going to create their salary that they replaced from their employer plan from before. You typically have to coordinate those to get to the amount of dollars that you need to live the lifestyle that you deserve. So let's dive into some of those different sources of income. The first one's Social Security. And again, a foundational income source for most all of those that are retired today. If you've paid in over the years, you've earned some sort of benefit. There's lots of talk about maybe Social Security goes away, maybe it's going to be reduced. Who knows what that future is? I talked about it in episode 2 that, I'd be really surprised if our political officials ever decided to completely get rid of Social Security. But Social Security is an extremely important part of most people's retirement plans. And what I find happening more and more is people are making bad decisions when it comes to the timing or the start time of those Social Security benefits. Where does that come from? Oftentimes it's from a coworker or those water cooler experts that say, hey, you need to turn that on as soon as you can, because what if you were to die and you don't get all your money back? Well, there's lots of different factors that go into that, and I'll dive into that at a later time. The decision does matter. The one piece that I will leave you is that every year you delay between age 62 and age 70, there's an 8% adjustment or increase in those Social Security benefits. Nowhere else in the world I'm familiar with that you can get 8% guaranteed growth on your income in the world that we live in. So another key component that I'll leave you with on Social Security is the whole if you're married concept. When one of you passes away, the remaining spouse gets to keep the higher of those two benefits. And we'll talk a little bit more about that here as the show goes on, but I truly believe that's pretty important. And one of the advices that I always give our clients is let's max out one of the two benefits and maybe turn the other one on earlier. Again, lots of factors go into that decision, but Social Security is very much a common income source for retirees out there today. Second one might be a pension from your employer. Again, we've talked about that in the last couple of shows. A pension may be available, and with that pension, you have to make the proper election, similar to Social Security timing. What is the best election for you in your situation? So whether it's a lump sum that you roll it over and take control, whether it's a lifetime income only for you, or whether it's some sort of survival benefit or survivor benefit for you and your spouse, those are all pretty key decisions that can really make up quite a bit of your guaranteed monthly income. And again, as I talked about in episode 2, circumstances matter there too, right? It may not just be the most amount of money. It may be what you want that money to do for you that goes into those decisions. The third most common source is your portfolio, right? Your 401k plans, your IRAs, your Roth IRAs. You've thrown all that money together and built up this pie or this pile of money that now we have to draw from. And the key to this deal, in my opinion, is that you need to have structure. You can't just guess or kind of willy-nilly pull those dollars out of there. Oftentimes, these dollars are used more for for your lifestyle or your fun money, more of your pull for a trip or pull to cover the golf membership at the end of the year. But we want to be strategic in how you position those assets to prepare for, whatever circumstances may come down the road. And then the final income source, not everybody has this. Some people do, but it's more of your guaranteed income sources. So whether it be rental income, whether it be the sale of a business that you had ran, maybe you've created your own pension-like income out of the portfolio by using some sort of an annuity contract. I think the key here, as we go through and helping our clients plan for this, the goal that we always take on is that we would like to generate guaranteed income high enough to cover your fixed expenses. Again, those things that will never go away, your insurance premiums, your utility costs, your taxes, putting food on the table. And if we can create a guaranteed income stream high enough to cover those fixed expenses, it puts you in a lot more flexible position or enjoyable position because you've got those needs covered on a regular basis. The key takeaway from income layering is that we really want to have a plan that coordinates how much you're drawing from each one of these and aligns with the needs that we've determined in your retirement plan. So you want your income to be as predictable as possible. You want stability inside of that plan, and you want a process that's easy to manage, right? Or a structure that's easy to understand, easy to manage, and provide you some of that comfort that our clients always talk about wanting. Now let's move on to why withdrawal order matters. This is a commonly overlooked area that I see people, when they approach their retirement, they're not really certain why or where they should take their money from. So they may be taking money out of their cash accounts or their checking accounts, or they may be taking it all out of the 401k and creating tax issues that they didn't even realize they were going to run into based on where they were withdrawing the money from. So 3 common account types that we want to talk about here, and I'm going to keep it very vague, but the first one would be your taxable accounts. So these are the accounts, again, checking, savings, CDs, maybe it's a joint brokerage account or an individual brokerage account. These are the accounts that every year you get some sort of 1099 or a tax document on saying that you've made so much in interest or so much in capital gains. And when you withdraw dollars from these accounts, you may have some tax consequences in capital gains, but not as significant of tax issues as what you'd run into when you pull money out of the second source, which is more of your traditional pre-tax accounts, 401ks, traditional IRAs, annuity type of plans that are out there. When you pull money from those accounts, that's when we're adding that amount onto your ordinary income tax. Goes to your adjusted gross income, goes into a lot of calculations that we'll get into later on. And third account type that's out there are your Roth accounts or your tax-free accounts. These are the portfolios that if you pull money out of, you have no tax consequence when you've pulled it out because you paid the taxes before you put it in. So those 3 most common account types. And the general rule of thumb, if you did any type of Google research or read reports on what accounts I should take the money from first, they would recommend that you take it in the order that I just shared, right? Take the money from your taxable accounts first, let the tax deferred or the pre-tax accounts, if you will, grow as long as they possibly can, and then let the Roth go forever if possible. I don't necessarily agree with that all the time because I think right now we're in the lowest tax rate environment we've been at as a country in well over 100 years. So I typically will look to try to help our clients maximize their tax situation or optimize their tax situation and strategically pull from the accounts that we need to in order to optimize your situation. But other things that come into play there would also be like your required minimum distributions, or RMDs as they're oftentimes called. This is an often overlooked planning scenario, but if you're 55 years old and you've got a significant amount of your nest egg in pre-tax accounts, at age 75, the government will force you to take withdrawals and pay income tax on those portfolios because you have haven't yet paid that tax. And surprisingly enough, the government would really like you to pay some tax on those dollars. So I think it's important to plan ahead or look forward, and thinking about paying tax at a 12% rate might be more efficient than delaying those account withdrawals until you're forced to take a larger amount and may have to pay at a 24% tax rate. So again, those are just some reasons why it matters. Other things that are out there are your Medicare premiums. If we hit a certain threshold, there's a deal called IRMAA, income related Medicare adjustment amount. So if we make too much money or have too much taxable money, now we have to pay more for our Medicare costs. So there's all those things that we have to run into or think about in the decision of where we're going to pull money from. And that's why withdrawal order matters. One really important concept, and a kind of a close to home story here, but I call this concept the widow's tax trap. So a lot of you may know, for those of you that don't, I lost my dad last year, and mom and dad had done an incredible job of building a nest egg and businesses and so forth. I got the pleasure of working with them here in our office for the last 20 some years. They had just retired. We had built most of their plan around both of them living into retirement, for the foreseeable future at least. But when dad died, we ran into an immediate concern, and that was the fact that mom would now be on a single filer return versus a married filing jointly return. And not a lot of folks have ever looked into that, but the amount of dollars that a couple can generate is significantly higher and taxed at a lower rate than what a single filer can do. So in thinking through when do we pay that tax, don't get caught up in the trap of only deferring things out as long as you can, because if one of the spouses dies, the other one may be left to have to pay those taxes at a much higher rate. Because let's face it, if one spouse dies, income often stays very similar. Lifestyles don't change. Travel plans may change a little bit, but not much. So we really need to be strategic in where we're going to pull those dollars from and when we're going to pull those dollars. Another big concept that goes into that is the Roth conversion. I don't want to get into the details there today because that'll be probably an entire show, but going back to maxing or optimizing that tax plan may include converting some of your pre-tax money over to Roth money so that you can control the tax rate that's going to be paid. And finally, let's talk about sequence risk and protection of the plan. And I think this is absolutely, fascinating information, and not a lot of people realize this stuff. So I wanted to share this and make this a part of your income discussion. And that's that most people don't realize that market losses will have way more impact on a distribution plan than they will on an accumulation plan. So what do I mean by that? What I mean is that as long as we're saving and not taking any money out of a portfolio, it doesn't matter what our returns are over a set period of time. So if I get certain rates of return every year for 10 years, at the end of that 10 years, the average rate of return will be the average rate of return. And the portfolio value will equate to the same dollar amount after that 10-year journey as any of those orders occur. But in distribution, it's an entirely different story. So let's tell a little story here. See if this helps resonate a little bit. So let's just assume that we've got $1 million portfolio. And after all the planning work that we've gone through, we determined that we want to take a 4% withdrawal from that $1 million portfolio. We won't get into the whole debate of what's a safe rate of withdrawal and all those things today, but let's just assume 4%. So we pull 4% out of $1 million, that's $40,000. After the withdrawal, let's just assume that happens the first day of the year. We pull that $40,000 out, we have $960,000 left. The markets that year go down significantly, and at the end of the year, our portfolio's worth $800,000. Imagine sitting in the chair and saying, okay, hey, we need to take our withdrawal for the following year. How much would we like to withdraw? We only are taking 4% of the portfolio, but 4% of 800,000 is now only 32,000. Or are we going to sit there and say, you know what, I'd probably rather have that 40,000 that we had planned for and we had talked about? Of course you're going to take the 40,000, but now that impact is that we've taken a 5% withdrawal from our portfolio, not a 4% withdrawal. Do you guys see where that impact could make a difference? So that following year, we took a 5% withdrawal, not in line with the plan that we had developed going into retirement, but market volatility now is forcing our hand here. So that's where you've got to be careful. And in a distribution plan, if you have a bad run, 2-3 years of down markets, you can really really impact the outcome or the value of that portfolio at the end of that same 10-year period. So we have to be strategic about this. So how do we manage it? How do you approach that sequence of return risk? Well, the first one, and nobody ever really likes this plan, is we could reduce our spending. We could say we're always going to take the 4%. So whether it's 40,000 or 32,000, we're just going to take 4% of the portfolio. Again, we've got to cut $8,000 out of our budget. Most retirees don't want to do that. We can use a buffer approach. This is oftentimes what we utilize with our clients, but we allocate some short-term money, some intermediate-term money, and some long-term money, and we take a lot of the risk off of the short-term bucket with the intent that that's where we're going to pull that $40,000 from. So it may not have a whole lot of fluctuation in the value, but we know it's safe to protect against any market volatility and provide the income stream that we need. The other one is we would have more of a structured withdrawal plan, maybe utilizing products like annuities or going back to some of those pension decisions where we know that 40,000 is going to be guaranteed for us through the benefits that the product may provide. Whatever strategy you take on there, I think it's just really important to know that as you go into retirement, you can't just leave all the money sitting in the S&P 500 portfolio and not take on any additional risk. Because if, again, we see a 2-3 year downturn in the markets, of which we have no control over, we may be putting our ability to know that money is going to be there forever at risk. So sequence of returns is a big risk that we're all facing. So how do we bring all this stuff together, right? In a plan, your income needs to be really coordinated, right? It all starts with what we talked about in episode 1 of determining how much money we need. Then we've got to go find where we're going to get those dollars from. It may be a combination of any of those 4 sources that we talked about earlier in the show, but we need to coordinate all that. We need to protect against risk. Like I said, sequence of return risk. What if we lived? Inflation risk, all those types of things that go into the coordinated deal. And then we also need to be tax aware. What are the tax consequences that occur if I take money out of certain portfolios? And when not planned, like income just becomes reactive. It becomes rash decisions that oftentimes lead to even worse consequences, let alone the stress and anxiety that creates. So making sure all that stuff is organized is really what my message is today. Address the risk, plan for the taxes, and make sure you've coordinated or organized those income streams to get you to a successful retirement. And again, I would leave you with this. The one thing I want you to take away, it's not about the assets that you have. It's about the income that it can generate. And I use this story quite often with clients, but it's an old story. I think I'd mentioned Tom Hegna in a prior show, but I picked this up from him and he said, oftentimes it's not the value of the cow that's important, but it's the amount of milk that it produces that you should really care about. Retirement planning is a lot of that same type of an approach. It's not about the size of the portfolio, but it's about the income that portfolio can create for you. And so in conclusion, the question I'd leave you with is this: can you clearly explain where your retirement income will come from? And do you have a plan coordinated to generate the most efficient income streams as possible in your retirement? If not, go put together the plan, find an advisor, give us a call. We'll figure it out one way or the other. I appreciate your guys' time. I hope this helps you again understand the importance of planning, and now go out there and be great.
This is Compliance Calling, securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA, SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The material discussed is meant for general informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Past performance is no guarantee of future results. Diversification does not insure against loss. Any guarantee language used pertains to insurance products, which are backed solely by the claims paying ability of the issuing insurance company. The opinions and forecasts expressed are those of the host and may not actually come to pass. This information is subject to change at any time based on market and other conditions and should not be construed as a recommendation of any specific security or investment plan. And that concludes our compliance call.